Welcome to the Master's Certificate in Technical Analysis. We're pleased to have you along, and as you can tell by the title of this course, it's designed to educate you in everything you need to know about technical analysis to make you a successful trader in any market condition. Now, it doesn't matter whether you're a newcomer to this business or whether you're already trading. Starting with the early modules will lead you through the fundamentals of trading, and by the time you finish, you'll be able to analyze any market and make profitable trades. Some of the things we cover you may know if you're already trading, but please just follow along and make sure that you know all the things we're discussing, as each module will build upon the previous one. So let's move on to Module 1, which is concerned with technical analysis and the Dow theory. This module assumes no prior knowledge at all and just requires an enthusiasm to learn. You'll understand why technical analysis has a sound basis and how Charles Dow, who lived at the end of the 19th century, started the whole business of analyzing the markets that 99% of all successful traders use today. Module 1, Part 1 of the Master's Certificate in Technical Analysis. This module talks about technical analysis and what it is and what the basis of it is. We'll give you an overview of what you're about to learn. Technical analysis is a fundamental tool which is used by all successful traders so they know how to trade accurately. During these videos, I'll often talk about markets and talk about stocks and shares, but technical analysis can be applied across many different markets, whether it's futures and options, contracts for differences, or spreads. But I may just talk about shares to make it more convenient. Technical analysis is based on market action. Market action is what we know about a trading market, and all we know. Think about it as how much something is sold for, and how many of that something is sold at that price. So we know the price of something, and we also know the amount in terms of volume of that something, and that's all we know historically. And from that we use technical analysis to try and project and figure out where the market may go in the future so we can place successful trades. In the futures and options market, we're not actually trading anything, we're trading a promise. In the futures market, we may trade and say, I'll sell you 100 ounces of gold in March. There's no limit on how many people can do that, and that's called open interest. Open interest is the number of contracts there are and the amount of goods that are to be traded at some point in the future. There might not be that much of a relationship to how much gold there actually is. For instance, it's a very interesting situation at the moment. Gold, in fact most of the gold that's ever been discovered, is still in use in jewelry and in other things. However, silver is an industrial metal as well as a precious metal. So a lot of the silver which has been mined is a byproduct of other minerals, which is also a problem. So a lot of the silver that has been mined has already been used up. Silver was typically used in old-fashioned photography, and a lot of that was washed away. Silver is also used in contacts, and silver is spread out in waste products all over the world, and there's not a great deal of it left. In fact, there's probably half as much silver available in the world as there is gold, but despite that, silver is actually cheaper than gold. When you look at the futures market and look at the open interest, you will find that the contracts out for gold only amount to a few % of the gold that's actually available in the world today. Now, if you look at the open interest on silvers, on the silver futures, you'll find that the contracts out there offer about twice as much silver as there is available in the world right now. So open interest is in no way related to the amount of the commodity that we have, and so it's a third factor in those particular markets that we can use to analyze and to try and determine where prices are likely to go. Now, there are three basic principles to technical analysis, or the three tenets, and these underlie what we do. The first one is that by looking at a price, we know all there is to know, and that market action discounts everything. This is an important concept, in fact a massive concept. Market action discounts everything means that we don't have to know about the fundamentals. We don't have to know whether a company is well managed or not, because that's already there in the price. The share price reflects all there is to know about the company, and therefore by looking at the share price we know what we need to know without needing to look elsewhere. The second principle is that prices tend to move in trends. This is something which you can almost instinctively realize. When a company is going well, the price of its shares will keep rising. If a company is falling, typically a big example of that recently was Toyota. Toyota with the problems on sticking accelerator pedals and the further problems on braking systems on their hybrids. Their shares steadily went downwards, or have a downtrend. Now here's an example of an uptrend. It's very basic, but it shows a simplistic view of an uptrend. Now this is how charts are normally laid out. Now please remember, this is a very basic view in a chart, and we'll talk more about charting and charting basics in module 2. Now we have time going along the bottom horizontally on the x-axis, and the price going up on the y-axis. So as we go from left to right, which we consider to be the passage of time across weeks or months or even years, and as we go up, the price gets higher, and as it goes down, it goes lower. And you can see the line that we've drawn here moving along from left to right, which means that basically we have an uptrend as the price is moving steadily up. Now there are some little jolts in the line, as you can see, and this is how charts typically work in practice, and we'll get more into that in the Dow theory section of this module. Typically you have a big rise in price, and then you have a little bit of a settling back period, and then you have another surge in price, and essentially this is the very, very basics of what an uptrend. And if you flip this on it upside down, you would have a version of a downtrend, which is basically the inverse of an uptrend. Now the other principles that we rely on in technical analysis is that history tends to repeat itself. Now all this is saying is that if we have circumstances that you had last week or last month or 10 years ago, then you can reasonably expect the same outcomes, the same things to happen. We use this, for example, in weather forecasting. When we have a low in one area and a high in another, we may say it's a probability of rain. And as with weather forecasting, you don't know for certain, but you can put a percentage on that. You can say 70% chance of rain, and it's the same with technical analysis. You can't know the future for certain, but you can put the odds in your favor by using technical analysis, and that's what makes you profit. Now, just as a brief diversion from discussing technical analysis, you can also have fundamental analysis. Both of them are concerned with stock prices or markets, but essentially what is the difference? Technical analysis is a very immediate tool. The trader wants to know what the stock is going to do tomorrow or next week, or maybe even today, this very minute. The trader wants to form an opinion on whether it is worth trading. So the trader uses technical analysis, which includes the immediacy that the trader needs and what the price is going to do tomorrow, or today, or next week. On the other hand, fundamental analysis takes the whole topic from a different point of view. Fundamental analysis says what the price should be. Is this company doing well? Are they selling lots of gizmos? Okay, the price should be higher. But that doesn't mean that the price is going to be higher tomorrow. Fundamental analysis looks at the bigger picture, the company financials, the annual reports. Is this the price of the company? Is this really what it should be? I want to invest my money for years is this a sound company that will grow? But technical analysis is not concerned with that. Technical analysis says what's likely to happen either later today or tomorrow or next week, because that's the trading timescales that technical analysts tend to use. Talking of timescales, technical analysis is usually associated with short timescales, but you can actually use technical analysis across any timescale at all. In fact, you can draw a chart year on year and you'll find analysis will still be effective in the long term, and once again we'll be talking more about this in Dow theory. Fundamental analysis expects to look at the bigger picture and what is the share worth in the long run. Basically, what is the company worth based on its accounts, on its order book. Technical analysis is more flexible than that and can be applied over minutes to years. So that's a brief summary of what technical analysis involves, what it is based on, and what you can expect from studying technical analysis. Now, there are many different aspects to technical analysis, and we're just giving you a very brief overview right now. There are all sorts of calculations that you need to do. That are done on price and volume, and we'll come to those in future modules. Thankfully, for everyone concerned, these calculations are done for you already. It's just the tools and methods and techniques that allow you to analyze what they're saying. And we'll come to that, of course, in future modules. So that's all for now. Just remember there's a second part to this module, part 2, and I'll see you in the next video, which is all concerned about Dow theory. So we'll see you there.